I'm Hunter Orr. I'm the Chief Investment Officer. I spend my day doing research. I'm looking at data and information, and I'm trying to figure out what's news and what's noise. What's the difference between the two? At the beginning of this year, we put out our 10 things that we thought would happen. So that's going to be a majority of what we're talking about. But I found this headline. From a newspaper, "Stock Market's Invincible. Buy, buy, buy." Can anybody tell me when this was from? What was that? 1929, the summer. Chuck, we're giving out golf balls for participation. I appreciate that. As we know, this coming out in the summer of 29, Stock Market Invincible was certainly not the case for the next 5 to 10 years. So we saw the headlines start to change a little bit. I'm just pulling some of the noise that we saw. Saw Wall Street in a panic. We saw depressions and recessions. We saw booms and busts. We saw oil problems. We saw inflation. There was a series of wars. But over the next 85 years, the market climbed this, what we call the wall of worry. Because the thing that was important throughout that 85 years is that the companies that we invest in, the corporations that are making up the stock market, they were making more money along the way. So through all of this noise, the headlines, all these things to be concerned about, you're focused on what's important, companies making more money, that's what we see here. So we put a video out at the beginning of the year. It was 2014 things that we saw, our outlooks for investing. It's available on the website. There's a bunch of other videos on there as well if you want to see it. But what I thought I'd do for the meat of what we're going to talk about today is go through those 10 things we said. I hope when you look at this, you'll notice what I was trying to do is have them be actionable. One of these 10 things that we said to either be able to be proven right or wrong. I wanted them to be something you could actually implement into your portfolio, something that we use as a decision to build your portfolio. So we're going to go through them and talk about each of them, how we got here so far, and what the next 6 months looks like. Louder. First thing we said was that the economy was going to do better than the markets. What we meant by that was relative to last year. So here's GDP growth for the economy. It was pretty average as far as coming out of a recession, 2.6%. But look at the gap between what the stock market did and what the economy did. That can't happen again in 2014, so that's our comment. The economy has to do better. The markets can't outpace it. Here's what we've seen so far in 2014. First quarter number for GDP was very low. It was actually the first negative number we've had in 5 years. Some people blame that on the storm we had in the Northeast. But look at the gap, the difference between what the stock market's done so far and the economy. And I think that this picture, I went back 25 years and pulled the relationship between the total value of the stock market and the value of our economy, so our GDP. Notice we use the term mean reversion. See how the stock market in yellow kind of always comes back to how the economy is doing? We've got our high periods. You see the tech bubble there in the middle, there's a big spike. The tech burst, you see this market going up until we reached 2007 and then the financial crisis. But throughout that period, it always came back to how the economy was doing. We're going to give ourselves a question mark on that one and revisit at the end of the year. This was a big point. I kind of wanted to make this point in an interesting fashion. I believe that interest rates should be above 3%. When I say interest rates, I use the 10-year Treasury as my benchmark, but whatever it should be, interest rates should be above 3. I don't think it's the first time that you all have heard that rates are low and they should be higher or they're going higher. But I thought it would be interesting to talk about why we believe they should be above 3, what really makes up interest rates. So there's two components. What we should demand is a real return, and then some compensation for inflation. And those two things make up what interest rates should be. So let's start with the real return component. I can go back 100 years, and on average, investors have demanded about 2%. It's a pretty constant number. So if the 2% number doesn't move, what causes interest rates to move? So what we demand for inflation. So that's different in 1980 when inflation is double digits than it is now when we've got low single digits. So in June, the Bureau of Economic Analysis came out and said inflation right now is just over 2%. So what should interest rates be? I demand 2% in real return, and I want to be compensated for inflation. In a non-manipulative monetary policy world, should be 4.1. We have quantitative easing, we have the Fed intervening, we have them buying bonds from banks. All those mean it is lower. In our opinion, it should still be higher than 3. Number next, point we made, this one's pretty clear and actionable. We said stocks will do better than bonds this year. That is a decision we can make in the portfolio. We can own more stocks than we would have if we didn't believe this. So I put a couple squiggly lines on here. Various stock indexes in blue, the S&P 500, the Dow Jones, the NASDAQ. I put a variety of bond indexes in red. So we've got corporate bond index and treasury bond indexes. And I think you'll notice two things. Stocks have done better than bonds, and stocks are more volatile. Okay? So for the next 6 months, we see the same thing. You will still see more volatility in stocks. We're going to talk about that. You will still see stocks doing better than bonds. And I'll tell you why. That's where investors are putting money. They're putting lots of money there. We're going to talk about it in a minute. We follow the institutions quite a bit, and what's happening as funds flow out of bonds and into stocks is something that we haven't seen in a very long time. We said volatility was going to be higher than normal. I got to figure out how we measure volatility. There's 3 ways to do it. And we'll take a look at each. First one we call big days. When did the market move more than 1%? The second thing we look at is something called the VIX. Has anybody heard of the term VIX? Does anybody know what VIX means? It's volatility. It's a scale we use. It's from 0 to 100. We're going to look at that. And then the third one is drawdowns. This is the one that actually matters to our portfolio. Is during the course of a year, how far did the market drop at a certain period? All right, so here's, I got the S&P on the left, and I've got the Dow Jones on the right. It's kind of a mixed signal. We've seen less big days for the S&P. We've seen more big days for the Dow. I'm going to look at the VIX. This is our VIX indicator. This is the last 20 years of it. And when I look at this, I see a general range-bound nature. It spikes, it goes up and down. I see these really large spikes. Financial crisis. That was a period of extreme fear. This one right here, does anybody know what that period of fear was? This is summer 2010, spring 2010. No guesses? That was not bank failures. This was October 8 in here. Flash crash. Does anybody remember that term? Seems like a really long time ago. We were very scared then. We didn't know why it happened. Well, look how quickly it subsided. This one right here, anybody know the late summer, early fall 2011? The rating agencies downgraded the U.S. debt. We got scared. Across this whole chart, last 20 years, the lowest period of volatility in the last 20 years. Anybody tell where that is? You looking right there, Everett? The summer of 2007. When people in summer of 2007 were very, very complacent, right? They weren't afraid of anything then. They should have been. Nice job. Zoom in just a little bit. I'm going to look at the last year and a half. Have we seen much volatility according to this VIX? Been pretty range bound. It's been pretty low. Our last way we look at volatility, drawdowns. If I look at all of 2013, the entire year, The biggest top to bottom drop that we saw wasn't even 5%. So far this year, we've already seen 2 moves larger than that. Late January for the Dow, and then in March and April, the NASDAQ had a move of almost 9%. So I look at volatility this year compared to last, I'm seeing more already this year. All right, so that's kind of the history lesson, but what's more important? What are we going to do the rest of the year? There will be volatility. This was kind of an easy one to get right. There's always volatility. But the important decision we make in the portfolios is, what do we do when that happens? When we see these drawdowns, when we see the big days? Do we get emotional, or do we make rational investment decisions? What's that? You know what? And that's a big topic. We all get emotional. I mean, I'm just as human as the next guy. With the fact that we notice that we do it, I think we've got rules that try and help us get through those emotions. I have a lot of fun with this one. The news and noise was going to be higher than normal. And it's the media company's job to do that. They put out stories. They've always got to have something interesting to grab your attention in the morning. Either something's failing, or some company didn't meet earnings, or there's some unrest in the Middle East. Whatever it is, there's always something. But I play a little game called Words We've Learned in 2014. These news stories, they've always got interesting headlines. So we learned Bernanke Light in early January, which to me, I have a little fun with my humor here, guys, which to me either means 2 things. It's a new variety of lager, or Janet Yellen was the new Fed president. She took over for her predecessor, Ben Bernanke, early this year. She's said to have very similar policies as Ben Bernanke Light. We learned a term, we heard news stories, taper reduction. That's not something we'd ever even heard of last year. Taper reduction either means using less tape on our packages, or this is the Federal Reserve is buying less bonds than they used to. They were buying a lot of bonds from banks. That's how they helped out with the liquidity. Now they're just buying less of them. And Janet Yellen has now come out and said, like to be done by October. We'll get into that. This one's actually my favorite. The Great Rotation. Don't get mad. So either the Rays pitching staff or this very important theme that matters very much to our portfolios, I referenced it before, the huge amounts of money flows that are coming out of bonds and into stocks. That's what they're referencing as the Great Rotation. So there's been more high-frequency flare-ups, rogue traders, big bank settlements, tax inversion now. This is a newer one. Companies trying to leave the U.S. tax code. Again, easy one to give myself credit for. There's always going to be the news stories. That's the media's job to do that. This one couldn't be any easier to be proven right or wrong and to implement into a portfolio and to actually see the results, see the dollar difference there that we've made from one decision. I said that value stocks would do better than growth stocks. What I mean by value stocks, those that pay dividends, those that buy back their shares, those that have a high quality of earnings, I can focus on that group. They make investable indexes and ETFs for that. Look at the other category, growth companies. Those that may not necessarily have high earnings right now, but their prospects are more in the future. These are actually 2 indexes that we invest in, we put in portfolios. We said value would do better than growth, so we had a lot more of the yellow line. It was that easy. Value has done better than growth so far, but fast forward, what do the next 6 months look like? And I could actually go out another year from that. The decision that institutional investors make, whether they're going to focus on quality dividend-paying companies or growth companies, those are long, slow cycles. They don't change their mind every week on those. The big amounts of money flows that changes how value indexes, growth indexes perform happens very long cycles. So for the next 6 months, we absolutely still like growth in our portfolios. Still like value in our portfolios, excuse me. I get asked about gold more than anything else.
We're giving away gold bars too.
Yeah.
I mean, it's a fun topic, and I think it makes a lot of people scratch their heads. Why did gold do what it did last year? This is a graph of what it did last year. This is where I was getting questions right here, right down there. What is going on? We characterized the performance of gold last year by fear and emotion. Gold at the top, go to the left of the chart there. Gold at the top at 1900 was maybe overdone, but from there, this trip all the way down to the bottom right-hand corner was fear. People were scared. They weren't sure what was going to happen with inflation, what was going to happen with the devaluation of the U.S. currency. I heard all sorts of questions, but people were scared. 2014, January 1st, our comment, and you can see it in the video on the website, we said gold was going back to fundamentals. 2013, the fear is out. Okay, now we're not emotional investors anymore. Gold's going back to fundamentals. So pay attention, I'm going to tell you what gold should be trading at. The fundamental value of gold. If I am a mining company and it's my job to pull gold out of the ground, whether I'm in Africa or the rest of the world, different dynamics there, but it costs me between $1,250 to $1,350 an ounce to pull it out. What happens if gold's trading at $1,000 an ounce? What kind of, I mean, get the man a sleeve of golf balls. Yes, if I'm in the business of this, if I'm not a trader, I'm in the business of pulling gold out, and I know I can only sell my product for $1,000, why would I spend $1,350 to pull it out of the ground? Now go back to Economics 101, supply and demand. I'm not going to pull gold out. Prices are going to adjust. So to me, the fundamental price, the floor, this base of gold, somewhere between $1,250 and $1,350. It's what we thought at the beginning of the year. It has done well so far this year. And for that reason, we still like it the rest of the year. That fundamental base isn't going to change very much. Our next point we made, I'm going to relate it to investing in just a second, but we said that employment was going to do better than wages. So I look at the unemployment rate right now at 6.1% was the last number we had. And it's been declining. And the Federal Reserve thinks we're getting fairly close to our full unemployment rate of in the fives. But I question, and we talk about all the time in our investment meetings, what's the quality of that unemployment rate? Are people getting the jobs that they want, the jobs they think they deserve, the jobs that they're educated for? Are they getting paid as much as they think they're worth? I don't think so. So this relationship, employment doing better than wages, I'm referencing that the unemployment rate would do just fine, but I'm not sure about the quality of those jobs. So how do we relate it to managing portfolios? How do we make that decision in your accounts? There's actually two things that people spend their money on, right? Things that we want and things that we have to have. So things we have to have: Tide, razors, food and shelter and clothing, right? Things that we would like to have: go out to the Cheesecake Factory, nice bottle of wine, an iPad from Apple. I can actually take those two different things I have to have, things I would like to have, and they are investable indexes, and it relates to this point. Here's our blue line. We actually buy this. It's called Consumer Staples. It's an ETF that perfectly tracks that basket of goods that people have to buy. Versus, we call this consumer discretionary, things you don't necessarily have to buy. Again, if I talk about whether this applies over the next 6 months, ask yourself the question on whether we're going to see drastic changes in the quality of employment over the next 6 months, year. I see this trend right here. The companies doing well, those companies that sell products people have to buy. This was one of our more braver 10 points. We said that there would be a market pullback of 10% this year. Hasn't happened yet. We haven't got that one. There's been two moves. You see the one in late January. The Dow was down almost 7% in that period. You see the one across March and April. NASDAQ did the worst, almost 9% drop. We may get a move of 10% over the next 6 months. Maybe a 9% move, an 8% move. I don't know if we can put a check mark next to this one. But I know that the important thing to think of when we're managing the portfolios is, what are we going to do when we get there? What are we going to do when we get 8, 9, 10% down? Again, go back to, are we going to make emotional decisions? We're going to make rational investment choices. Are we going to think back to the previous 8 points we just made? Stocks are going to do better than bonds. We want to own value indexes. It's okay to own some gold. All those points, maybe these are the opportunities to buy those things that we'd like to buy. This is our last of the 10 points that we said was going to happen. I could spend a lot of time here talking about it because we spend a lot of time in our investment meetings and doing our research in this category. We call it non-vanilla equities, which is our terminology that you can just buy stocks. I can go buy the S&P 500. I can buy the whole index. That's very vanilla. That's plain. Or I can go off and do some additional research into the little niches that are out there. I can go research that energy part of the stock market. What are the MLPs and energies doing? If these aren't familiar terms, that's fine. We live in that little world. REITs. REITs behave like stocks. They can be up and down investments. REITs are up. The REIT index is up about 14% so far this year, far outpacing stocks. The energy MLP index is up 8.5% so far this year, outpacing stocks. So if we can spend our time going into those areas, do our diligence, trying to find things that are non-vanilla equities, we can add some value. I really do feel like these categories are going to be very, very important throughout the next 6 months and actually a lot longer than that, because there's going to be little pockets of undervaluation. You can go find things that offer great risk-reward opportunities. So circle all the way back to the beginning where we started. We were going to make 10 points. I really wanted them to be actionable. You could actually do something in a portfolio with them. I could be proven right or wrong. I'm wrong quite a bit, so that's okay with me. But we got some right as well. This is our scorecard so far. We're going to update it at the end of the year. We're going to put a finishing stamp on it. It says, yes, we got that one right. We got that big decision that Sean was referencing. We got it right in the portfolios, and it made a difference. Just wanted to give the 10-point outline. But we do have Sean, managing partner of the firm, and Carl with BlackRock. Carl spends a lot of time in New York talking to portfolio managers of all different various asset classes. So I want to open this up to a real live Q&A. It's maybe a drilled down one of the points I was just talking about. And we can talk about anything you want to talk about while you keep eating. And we'll make sure that I get all the easy questions and Carl gets all the hard ones.